Hello everyone, my name is Ben with IncomeOptionsTrading, and today I wanted to go over a trade I did in AMC that I posted on Twitter. Tom with tastytrade did something similar in GameStop, GME, but his trade used about $85,000 in capital, where this trade here that I did in AMC took about $9,000 in capital, so a lot less than the GME one. So here's the chart of AMC. You can see that typically it's in the $2.50 to $10 range. There was a spike back late January, early February. That corresponds with the GameStop fiasco. And recently AMC has jumped from $10 May 24th up to it hit a high of almost $73 on June 2nd. So it's really shot up here. Volatility is really high. So I wanted to do a trade that captures that volatility in some way or uses that to my advantage. And the way I did that is I went into the option chain here. I looked at the 38-day to expiration. I could have went with any of these, but typically the monthly expirations are more liquid. So I went with the July 16th expiration. And what I wanted to do was, because there was such heavy call skew, I wanted to do something with the call spread, because the call spread would be pretty cheap because of the skew. So what I wanted to do was set up a call ratio spread. And a call ratio spread, all that is selling more calls than buying the calls. So with this call ratio spread, I bought 23 of the 140 strike and I sold 24 of the 145 strike. So basically I have 23 debit spreads with a leftover naked call. So my risk here is one naked call in AMC. So what I ended up doing is I highlighted the 140 and the 145 strike, and I went to 23, and then if I highlight just the 145, I can go to 24. So I have 23 of the 140 call strike and 24 of the 145 call strike. And I was playing around with this, and what I wanted to do was do this call spread for just over $1. So when I did this earlier today, this was a 120 credit. So I got $120 of premium for doing this trade. Now it's at about 90, so I'm up $30 on the trade. My buying power here is about $9,000. And my max profit is just over $11,500. And where would I get that profit? I'd get that profit if AMC expires at 145 on July 16th. So I can go to the curve mode here and we can take a look at this trade. And it won't be as good because with tastyworks, the risk graph only goes up to the last strike. So it only goes up to 145, so you can't see past that. But basically how this chart would look if it extended, this goes up to 145, it peaks here, and then it gradually goes down to our break even. And what our break even is, or the way that's calculated, is this is a 5-point debit spread. So if AMC closed at 145, I would be up on 23 debit spreads, the full profit. So that would be 23. And this is a $5 wide debit spread, so that's $500 a piece. So times 500. And there's my max profit, $11,500, plus the credit that I took in, which was $1.20. So I was actually at $11,620 is my max profit. But I have this leftover call. So if I pin the 145 strike, these short calls expire worthless or very, very cheap. But to figure out my break even, let's say that AMC goes past 145. I have this leftover call here. So that call would need to lose $11,500 before I broke even. So basically, I would take 145. I would convert this 11,500 into options pricing, which is $115. So if I took 115, I added 145. 260 is my break even to the upside. So if I go back to this graph here, so as I said, this line will decline like this, and it'll cross into the negative realm at 260 plus my 120 in credit. So it'll cross at 261.20. So as long as AMC stays below 261.20, I make money. And you can see this on the bottom bar here. My pop is 99%, so pretty high chance of making at least the 120, or at least making 1 penny, I should say. The chances of hitting above 145, I don't think it's very good, but GameStop went up to 400 or something like that, so definitely possible. So I'll be taking a look at this trade throughout this week and next week. I'll try to maybe buy back a couple of these call ratio spreads and lock in my profit. So what I mean by that is I'll try to maybe close out of 10 of these. So I'd sell 10 there, buy back 11. And I would try to do this for less than $1.20. And if I do that less than $1.20, I'll lock in that difference as profit, and I'll have a free shot at, in this case, it would be 13 debit spreads. So I'd be left with 13 140 strikes, and 24 minus 11, I'd be left with 13 at the 145 strike. So then if I took 13 times 500, in that case my max profit would be 6,500, and that would be if AMC closes above 145. So a couple people on Twitter have asked me, why did I do the 23 by 24? So as I said before, I started with a 10 by 11, and I tried to do as many contracts as I could so that my credit was just over $1. So if I do this, I'll get more than $1. So here I'm getting $5.45 in credit. So in this scenario, I'm getting more credit up front. So in this case, $545. But my break even is substantially less than the 261. So if we want to do the calculation here, we have 10 call spreads. Whoops, I'm just going to close that. So we have 10 times 500. Our max profit is $5,000, but we have one leftover call. So that one call would have to lose $5,000. And in option speak, that'd be $50 here. So you would go 50 plus our short strike, which is 145. And that would leave us at a break even of 195. So it'd be roughly $70 less for a break even if we do less contracts but get more credit up front. So that's the benefit of doing more legs on each side compared to a lower amount. Typically when you do a call ratio, or what most people think of is a 1/2, and same thing where we're getting much more credit, 860, but my break even is only going to be the 150 plus 860. So 150, 860 would be my break even. So doing more legs gives you a lot better break even. The way I see it, if you're going to do something like this, you might as well just sell the 145 put or 145 call, excuse me, and call it good. That would give you the max credit but the lowest break even. So that's the trade I did in AMC. If you have any questions, feel free to leave them in the comments. Otherwise, thanks for watching.